Your bank is not your friend. I know that sounds dramatic. But stay with me for the next 10 minutes because I am going to show you with real numbers, real facts, and real data exactly how your bank is legally, systematically, and deliberately taking your money while making you feel like they are doing you a favor. The most infuriating part of all of this is that everything I am about to tell you is completely legal. Your bank is not breaking any laws. They are simply playing a game that you were never taught the rules to. But after this video, you will know the rules. Let us start at the very beginning. What is a bank actually for? On the surface, the answer seems obvious. A place to keep your money safe. A trusted institution that holds your hard-earned dollars and gives them back whenever you ask. That is what most people believe. And that belief is exactly what your bank counts on. Here is the reality. When you deposit $10,000 into your bank account, that money does not sit in a vault somewhere with your name on it. The moment your deposit hits the account, it becomes the bank's money, legally, by the terms of service you agreed to when you opened the account. Thanks to something called fractional reserve banking, the bank does not just lend out your $10,000. They use your $10,000 as a reserve to create and lend out up to $100,000 in new money. 10 times your deposit. Your $10,000 deposit becomes $100,000 in loans the bank collects interest on at rates of 6%, 8%, 15%, sometimes 24% on credit cards. Meanwhile, they pay you 0.01% to 0.5% on that same deposit. You just funded $100,000 worth of loans for the bank, and your cut of that is $1 per year if you are lucky. The Consumer Financial Protection Bureau reported that American banks collected over $15 billion in overdraft fees alone in a single recent year. $15 billion. From people who accidentally spent $5 more than they had in their account and got charged $35 for the privilege. And overdraft fees are just the start. Monthly maintenance fees, minimum balance fees, ATM fees, foreign transaction fees, wire transfer fees, paper statement fees, inactivity fees, early account closure fees. Your bank is charging you for the privilege of letting them use your money to make billions of dollars. According to Bankrate, the average American pays over $200 per year in bank fees. That is $200 per year simply for the privilege of letting a bank use your money to make billions. But the fees and the interest rate manipulation are not even the most powerful tools your bank uses against you. The most powerful tool is far more subtle. It is called financial illiteracy by design. Banks have a profound interest in keeping their customers financially uneducated. The less you understand about money, the more dependent you are on the bank. This is why banks do not proactively tell you about high-yield savings accounts that pay 40 to 50 times more interest than their standard savings accounts. Because if you moved your money to a competitor offering 5% interest instead of 0.01%, that is money leaving their ecosystem. According to the Federal Reserve, the average credit card interest rate in 2026 is over 21%. 21%. And your bank is counting on you not fully understanding how devastating that number is to your financial health. The Federal Reserve also reports that nearly half of all credit card holders carry a balance month to month, which means they are paying 21% interest on purchases they made weeks or months ago. Because if you truly understood compound interest at 21%, you would never carry a credit card balance again. Now let me talk about mortgages. A $400,000 home with a 30-year mortgage at 7% interest requires total payments of $957,600. You will pay $557,600 in interest alone. Over $500,000 in interest on a $400,000 purchase. The bank makes more money on your mortgage than the home actually cost. And here is what banks never volunteer to tell you. In month one of a $400,000 mortgage at 7%, your payment of $2,660 breaks down like this. $2,333 goes to interest. Only $327 goes toward paying down the actual loan. You made a $2,660 payment, and only $327 of it went toward owning more of your home. This is called amortization, and banks love it. Because in the early years of your mortgage, they collect maximum interest while you make the psychological progress of feeling like a homeowner without making much actual financial progress toward owning the home. Your credit score was invented by the Fair Isaac Corporation, known as FICO, in 1989. And while it was presented as a tool to help lenders assess risk, it functions very powerfully as a mechanism that keeps consumers dependent on credit products. A good credit score is built by using credit, by borrowing money, by having credit cards and using them, by making payments on loans. The system literally rewards you for being a borrower and penalizes you for avoiding debt. Think about that. Your credit score is not a measure of your financial health. It is a measure of how valuable you are to the banking industry. The very metric most landlords, lenders, and employers use to evaluate your financial responsibility is fundamentally designed to encourage you to remain a profitable customer of the banking system. Now let me show you exactly what you can do about all of this. 5 actions. Start all 5 today. Because I did not bring you here just to make you angry. I brought you here to show you exactly how to play the game differently. Action number 1. Move your savings immediately to a high-yield savings account. The big traditional banks are paying between 0.01% and 0.5%. Online banks like Marcus, Ally, and SoFi are currently paying between 4% and 5%. Same FDIC insurance, same accessibility. 40 to 50 times more interest. If you have $20,000 in a traditional savings account earning 0.5%, you are making $100 per year. Move that same $20,000 to a high-yield savings account earning 4.5% and you make $900 per year. $800 more per year for doing absolutely nothing except moving your money to a better account. Do it today. After this video, action number 2. Never carry a credit card balance. Credit cards used correctly are one of the most powerful financial tools available. Cashback, travel points, purchase protection, all free if you pay your balance in full every single month. But the moment you carry a balance at 21% interest, you have handed the bank a weapon to use against you. At 21% interest, a $5,000 credit card balance that you make minimum payments on will take over 20 years to pay off and cost you over $8,000 in interest on a $5,000 purchase. Pay your credit card balance in full, every month, without exception. Treat your credit card like a debit card. Action number 3. Understand your mortgage before you sign it. Use a mortgage calculator to see the full amortization schedule before you commit. Understand exactly how much of each payment goes to interest versus principal in every year of the loan. And if possible, make additional principal payments. Even $100 per month in extra principal payments on a 30-year mortgage can save you tens of thousands of dollars in interest and shave years off your loan. Because every dollar of principal you pay down eliminates the interest that would have accrued on that dollar for the rest of the loan. Action number 4. Use your bank. Do not let your bank use you. Keep only your emergency fund and short-term spending money at your bank. Move everything else, your investments, your long-term savings, your retirement funds, out of the bank's ecosystem entirely. A simple S&P 500 index fund in a Fidelity or Vanguard account will dramatically outperform any bank investment product over the long term. Every single time. Your bank wants all your money in their products. Every product you have with them is another revenue stream for them. Action number 5. Build your financial education aggressively. The banks profit from your financial illiteracy. The most powerful thing you can do is become financially literate. Understand how compound interest works in both directions, for you when you invest and against you when you borrow. Now let me show you what happens when you apply all 5 of these actions simultaneously. 2 people, same income, same bank, completely different choices. Person A, traditional bank customer. Person B, financially educated customer. Person A, after 10 years, $1,000 in savings interest earned, $15,000 in credit card interest paid, $50,000 in mortgage interest paid unnecessarily. Bank investment products dramatically underperforming simple index funds. A decade of being on the wrong side of the banking system. Person B after 10 years. $9,000 in HISA interest earned. 0 credit card interest paid. $30,000 in mortgage interest saved through extra payments. Index fund investments significantly outperforming bank products. The same bank, the same income, a completely different outcome. Same income, same bank, completely different outcomes. All because of financial knowledge. That gap between person A and person B represents hundreds of thousands of dollars over a lifetime. Not from earning more, just from knowing more. I am not telling you that banks are evil. Banks serve an important function in the economy. They provide liquidity. They fund businesses. They make mortgages possible. They protect your deposits through FDIC insurance. What I am telling you is this: your bank is a business. And like every business, it will take as much of your money as you allow it to take. The rules of the game are designed to benefit the bank. But you can learn those rules. You can navigate around the worst of them. And you can keep dramatically more of your own money by understanding how the system actually works. The people who lose to the banking system are the ones who never look behind the curtain. The people who win are the ones who see exactly what is happening and make different choices. You have now looked behind the curtain. What you do next is up to you. You can go back to trusting your bank blindly, or you can take these 5 actions starting today and begin playing the game differently. One path leads to funding the bank's profits for another decade. The other path leads to real wealth. The question is not whether this information is true. You have seen the numbers, the Federal Reserve data, the CFPB reports, the bank rate statistics. It is all real. The question is what you are going to do about it. Starting today, right now. After this video, here is your complete action plan one more time. Move savings to HISA today. Never carry a credit card balance. Read your mortgage amortization schedule. Move investments out of bank products into index funds. Build your financial education every single week. Start all 5 today. If this video opened your eyes, share it with someone who still trusts their bank completely without questioning anything. They need to see this. Subscribe to Investor IQ for weekly videos on building real wealth and protecting your money from the systems designed to take it. New video every Wednesday. See you in the next one.